Very good afternoon and welcome to HYCM's webinar, Online Trading Workshop with myself, Giles Cochran. We will be looking ahead to see some of the key market events that we have coming up. So I look forward to taking us through and getting us ready for the week ahead. So just as folks are coming into the webinar, just going to make it clear that as we're going through these trades and outlooks, the idea of this FX week ahead is to get ready for the week ahead. It's not meant to be trading advice. I'm meant to be showing an education so you understand this from an educational perspective. So I hope that's clear as we get stuck in. Very good. So without further ado, we will look at some of the key market moves that we've been seeing recently. Now, we've had quite an interesting week to start us off. I'll just go to, that's it, just change screens. Now, one of the big stories, of course, that came in last week and we've seen into this week is the dollar weakness. Now, the dollar has been weak in a number of different areas. There's been the reflation trade out of the US. There's the US dollar acting less like a safe haven as there's some stability in the financial markets. We've had rising COVID-19 cases in the US has put further pressure on the US dollar. And we've also had a big recovery fund, a 750 billion euro recovery fund agreed out of Europe, and that has put on some strong US dollar upside, which has weakened the US dollar. So that weakness in the US dollar, we've seen that all through the majors coming in through to the session, and that dollar weakness is expected into the FOMC event on Wednesday when we have the Federal Reserve interest rate meeting. We will cover that during the session. Just want to also flag your attention to gold market. We can see that both the silver and the gold market have moved extremely high. We had the silver market moving up over 6% today, and we also have the gold market taking out those all-time highs, that 1922 region. You just see here, these are the all-time highs, and price now trying to break above that. If we get a break and close above those all-time highs, that does open up the way to the next target at 2,000, and above that, the target up to 2,200. So keep your eyes carefully on the gold market. Now, one of the little techniques I've been sharing with people is when you don't get a pullback in a market like this. So, for instance, in silver trade, I showed folks last week how I entered this market. We had this break of the trend line. We had the bullish fundamentals for gold and silver, very strong. They entered with the confirmation of the break on this weekly time frame, and price just rocketed higher. Now, when you're looking for a pullback, but one might not necessarily come, look for a continuation pattern. So we had one today. Unfortunately, I missed this trade, but it was a good example of a continuation pattern. We just had here this kind of symmetrical triangle forming. It's a very helpful little technical pattern. It's a part of the classical technical analysis that's widely followed by many traders. So whenever you get this sort of symmetrical triangle, it's almost like a flag. It's not a bullish flag. It's definitely a symmetrical triangle, but it's indicative of higher prices, and it's a continuation setup. So look out for this kind of action on silver and gold in the coming weeks and months. It's one to be looking out for. This is on the 1 hour chart. Unfortunately, I couldn't get into it because I came to my desk on Monday and the price had already moved, and I was looking for a buy on stuff above that 22.96 region, and I didn't want to leave the order in over the weekend, obviously. That was surprised to see price moving so high so early on Monday morning. And the target is obviously the extension of the pattern. So the pattern is from this 23.26 region down to the 23 to 15 region. So that's around 100 odd points. And so you just extend that same target, which would be around that 24.15 region would roughly be your target in this instance. So that is just keep your eyes on gold and silver charts. We may not get that deep pullback And so just to be aware of that in the market and looking out for those kind of price action. Obviously, we're just extending for now above those daily highs. So definitely a market to keep an eye on, potential volatility in the market as well. Now, the reason for the silver and gold weakness is such low interest rates around the world. You can see that the bond yields here. Now, when you have bond yields low, that's indicative of lower interest rates. So, bond yields are, here's the US government 10-year bond yields. Just look on a monthly chart, you can just see how low these bond yields are. Look, going back to 1981, it's the lowest they've ever been. So interest rates are expected to be low and remain low for a considerable amount of time. And that pattern is just mirrored around the world. So these low yields are very conductive. This is the monthly chart. See how these German yields are actually negative. So that actually yields a negative yield. So you're literally paying for the privilege of lending money to the German government. So that gives you an indication of how negative cash is. And obviously with inflation rates being above these 10-year bond yields, then it means that in real terms, this is a negative yield for the US. That kind of environment is very, very strong for gold. That's why we've been seeing gold just going on an absolute roar since the start of the year. We've just seen that strength carry on all year. We had the blip in gold here, which is with the pandemic really started breaking out. And that's, you had some gold traders taking gold longs off the table to offset the large falls in the equity market. Since then, gold prices have recovered and are making their way up and breaking all-time highs today. Key region, this overhead resistance level, key region break and close above that, and then we're looking at that becoming support, and then next up to that 2,000 US dollar level. So that's one to watch going forward. That fundamental bias for gold is still upside. It's hard to know whether we'll get a pullback or whether we'll get a close and a bounce. It's impossible to say, obviously, but just to be aware that if we get a deep pullback down to this sort of 1825 region, that would be suitable. You'd expect to find buyers there. And if you've got a more shallow pullback, then look for that continuation pattern and look for a break to the upside. A lot of traders last week, I was sharing with you how I entered on a simple trend line break of the 4-hour chart. You just had that trend line just going across the top. Very simple entry here into 1815, and I rode this all the way up into this region here to 3 positions, one off very tight, one off a little bit higher, and one off deeper into that zone. So you can potentially look for something similar if we get this sort of trending action back down into that support zone. So look out for that in the coming week. It's certainly gold and silver, a lot of action in those markets. So definitely want to really keep on your radar going forward. Another trade I wanted to flag up to you is the euro-pound pair. You'll see the euro-pound pair just breaking out this ascending trend line. There's positive reasons for the pound strength. For the euro strength. European Recovery Fund agreed last week. Market's taking this very positively. The fact that the Eurozone is working in a consolidated, unified way to support the whole zone, very positive for the euro. The fact that COVID-19 cases are falling in Europe, positive for the euro. Also, this dollar weakness is very positive for the euro. The dollar index, often called the anti-euro US dollar index, it moves in exact opposition to the euro. So if you just compare the euro US dollar chart, so if you put the euro US dollar here on this dollar index chart, you will see that the dollar index, let me show you here. Let's just turn that red. That is the euro US dollar. You can see that when the dollar index falls, the euro US dollar pair moves higher. When the dollar index rises, as here, you see the euro US dollar moves lower. So at the moment, this expectations of dollar weakness is further supporting the euro US dollar pair. And you can just take a look at that and see that strength that's coming into the euro US dollar pair is dollar led. So there's more reasons for euro upside. And we obviously have the pound is weak on Brexit concerns with time running out towards Brexit. and no major breakthrough expected potentially till September time now. So the general outlook for the pound is sort of Brexit negative. So this does favour euro pound upside. Obviously, a key technical sign here would be a break of this ascending trend line. You have the trend line 1 touch, 2 touch, 3 touch, it's valid. And now a break and close above that trend line opens the way up to higher prices, potentially looking at a target to that 0.9300 level. That next near-term resistance level would be a good target for euro pound buyers. Just flagging that up. Risks to that outlook, well, if we got some very positive Brexit news, that would result in euro pound downside. If we had a rise of COVID-19 cases in Europe, obviously keep your eye on Spain, that would be negative for the euro as well. So there's a couple of risk factors to be looking at in that trade coming up. But otherwise, fairly decent swing trade. Looking at stop losses running at 0.8900, and then if we're getting price closing back into this ascending trend line, that will be an area to look to remove the position and limit loss. So that's one potential trade outlook. I just wanted to flag up to you as we get going. Now, as we come back to our main screen. Okay, so just looking ahead at some key events for the coming week. Now, I have here a chart which is the weekly economic index. This is the New York Fed weekly economic index, and it just started to slow down. You can see that slight dip at the end of the graph, and that points to a slowdown in the current US economic recovery. I also want to show you this. This is small businesses in the US. Now, small businesses in the US, very important for any part of the economy. And the number of small businesses open has decreased by 14% compared to January 2020. So you can see at the start of the year, January 2020, that US small businesses have decreased by 14%. So there's growing concerns about these looming deadlines coming up this week for stimulus measures in the US. There's some real significant political decisions that have to be made. So that's part of the reason for the dollar weakness. It's that the Federal CARES Act is due to kind of expire at the end of this month. And the question is, particularly focus about this job in unemployment benefit of $600 per week. The question is, will it be extended? Because some politicians are saying that it incentivizes people not to find work because the payment is so generous. Other politicians obviously want that in place to support people in their struggle to find work. So there's going to be a debate in the US, and whether the stimulus bill gets agreed this week or not is going to be very important for risk. In particular, the stock market is going to rise or fall on these economic recovery stimulus packages. So if no stimulus gets agreed this week, then that's going to be negative for stocks, and that could potentially be positive for the US dollar if we see risk flows coming back into the US dollar. It's harder to tell at the moment because the US dollar has stopped acting as a safe haven as of last week, and is focusing on the reflation trade out of the US, which is a weak US dollar. So we have to play it by ear what's happening with the US dollar. Certainly have the dollar index on your radar. But if we do get stimulus agreed, then we should expect to see US dollar weakness continue, and we can see a stock market recovery. So that's something to be looking out for. Now, here's some of the concerns for the US. This is initial jobless weekly claims, and they rose last week. Now, this was in response to states in the US starting to return some of them back into lockdown. That's why we saw more initial weekly jobless claims. So a slight uptick. That's a bad sign for the US economy. The US does not want to have more people initially filing for joblessness. So that's something very crucial to be looking out for. Well, that data is important, and it just shows you some of the areas of concern. So with these things, slightly dip in the Fed weekly economic index. We have the initial jobless claims slightly rising, small businesses, that slight peak downwards, 14% since January. So you can see here that in the NASDAQ, Euro stocks, the German DAX, we can see the S&P 500, there has been that dip to the downside. So you can see here, this is March highs before the coronavirus impact, and the coronavirus impact came. All the equity markets fell heavily. Equity markets have been made a recovery on the hopes of all the stimulus that's coming from all over the world, ECB, the more stimulus expected from the Federal Reserve, from the US rather, from the Bank of England. It's all been supporting stocks very, very strongly. But there's slight downturn next week. So that's where we are in the markets. We're just in a wait and see mode. But there is so much risk in the markets at the moment with this political decision. We have the Federal Reserve meeting this week. But remember, this is the key thing to remember, the markets have continually been optimistic. They keep hoping that the Federal Reserve is going to support the economy as it has been doing, and that the US will keep bailing out the companies, and that if that's the case, then we'd expect to find buyers on these dips. So that's something to be looking out for very, very carefully as we come up to the Federal Reserve meeting on Wednesday and the stimulus decisions and whether they get done this week. So we're now going to have a look at one more thing. Yeah, this is the Fed's dot plot. There is no expectations of any increase in interest rates at the Federal Reserve for 2 years. So no expectations for interest rate rises this year, next year, or indeed 2022 really. So it's only 2022 that you start to get some rate hike projections. So that's something to really bear in mind, that low interest rates, particularly thinking of gold prices, are expected to be around for some time. So that is definitely going to be an area with which to keep your eyes peeled and alert to. Also, key events we have this week. This will impact risk, particularly thinking of the NASDAQ here. This is earnings season coming. We're in earnings season now, and there's some big technological earnings decisions to be made this week. Wednesday have Facebook, Thursday have Amazon, and we have Apple. So this is going to be key for the NASDAQ. You're taking a look at the NASDAQ, there is potentially a double top forming. I'll just show you that. Just take a look here. This is the NASDAQ. You can see here this 1, 2, this is the trough in between. So this area here on the NASDAQ, just zooming out, we can have a look. You can see NASDAQ making these record highs, but putting in some bearish candlesticks at the top. And the question that the market is asking is this a double top for the NASDAQ? The area to watch is a clean break of this 10,360 region, 10,360, a clean break of that level, and you potentially look for a move back down into that 9,700 level. That's one area to watch, coming up with all that risk that is in the market. So there's plenty of risk. We'll just go through some of the key events that we have. We have German IFO business climate. We had 3 good data points out for the euro this morning, and that was supportive of risk. And we have had a good data point for the eurozone. So that's more upside for the euro, based on Germany getting back to speed. We have some CPI data out for Australia on the Wednesday. It's not a major focus, but obviously any major upside surprise could be positive for risk. So remember, the Australian dollar moves around on risk movement. So if we're in a risk on market, then we expect to see the Australian dollar rise. Okay, so be aware of that. So CPI data, as well as Australian dollar, is a key risk currency. The main event of the week is the FOMC rate statement. Now, nothing much is expected here. The FOMC is expected to keep rates on hold at the current range, they are expected to maintain bond purchases at the current range. So they're also basically expected to be in a wait and see mode. So there will be some pretty intense scrutiny, obviously, of what they're doing. In particular, there's two areas that are really important. One is negative interest rates. If there's any talk of the Federal Reserve using negative interest rates, then we'd see even more gold upside. So look out for that. Any chat about negative interest rates at the time would result in immediate gold upside. Also, if there's any talk about yield curve control. Now, what yield curve control is this? It's a way of keeping borrowing costs down and supporting the economy. So if the Federal Reserve gets worried that these yields and these 10-year government yields, that they're going to worry about them getting higher, making borrowing costs more expensive, they can do something called yield curve control, which is essentially buying bonds to keep these yields low. Okay, so if they explicitly do that, then that is a very positive move for stocks. So look out for that. But remember, there's not much need for yield curve control at the moment because yields are so low. We saw on a monthly chart, didn't we? Look how low they are. But if the Federal Reserve does mention yield curve control, just to be aware of that, that again would result in strong upside in stocks. So S&P 500. NASDAQ, etc. That would be very positive for the stock market. So that's something to be aware of going forward. Looking now to the next day. July 30th, preliminary GDP out of the Eurozone. Again, that will be important. Very important for the Eurozone, Germany's data. Germany is the largest nation and the biggest contributor to the Eurozone. So the German data has a strong ability to impact the euro. So any positive data from Germany will be supportive for the euro, and a very poor data point obviously would be negative for the euro. So that's one to take an eye of. Got advanced GDP, again, huge losses expected for advanced GDP. Expected to show a forecast of minus 35%. Absolutely shocking, the bad. So the surprise here, the risk for this is the upside. So if it's not as bad as expected, you know, minus 20%, minus 15%, I'm not sure exactly what the expectations are going into this event for the week, but that's certainly something to be keeping an eye on. The market impact is likely to be limited because this is backward-looking GDP, and the range of expectations are very wide. It's a little bit of a stab in the dark, you know, minus 35%. So the surprise here would be if it was, you know, if it was a positive number, that would be fantastic and very positive for risk. So that's one to watch out for on Thursday. China. This manufacturing PMI is important as well. Again, expected to be an expansionary territory above 50. Anything 50 is expansionary. The market will want to see this rising. If this falls, that would be very negative for sentiment. But obviously, with most of China, you know, fully operational again, we can expect that the PMIs to continue marking a positive reading. 50.8 is expected. Anything, you know, above 51, 52 is going to be supportive of the risk trades because it shows that China, which is the world's second largest economy, bringing in about 15% of the world's GDP, is operating well, and that has a potential to impact risk. So don't forget that. And obviously, in terms of trading, the Australian dollar is traded as a proxy for the Chinese yuan. So very good data here would benefit the Australian dollar. Very bad data here will also weigh on the Australian dollar. Definitely one to look forward to. Final data point of the week is GDP data for Canada. Now, a little bit of nervousness for Canada. Because there's so many COVID-19 cases rising in the US now, the concern is that Canada's growth is going to be hurt because it's not able to trade so freely and openly with the US, which has some states going back into a lockdown mode. So that is something to really keep a careful eye on for Friday's data point. Good, strong data here, potentially supported for CAD, but don't forget CAD is moved around with oil. So just to be aware, we've got this ascending trend line on the oil chart. Just taking a look at oil, you can see that trend line moving up higher. If we see a break and close below here, then we would potentially favor more downside in oil. There's fundamental reasons for oil weakness, so be aware of that. And if we see a break and a close below this ascending trend line, then we can see the market taking notice of some of those fundamental bearish reasons for oil. That would be a key trigger, and then that would also weigh on the Canadian dollar. So just bear in mind that if you're trading the CAD is correlated very closely with oil. So basically, when oil is moving higher, we'll see, let me just show you. It's a great correlation to see. You'll see that, let's compare US dollar CAD. So you see, like when oil is going higher, you can see US dollar CAD going lower. When oil is going higher, US dollar CAD is going lower. When oil is going lower, US dollar CAD is going higher. Okay, so you can see here, as oil's been going lower, we had US dollar CAD higher. Now, as we see oil going higher, we've got US dollar CAD lower. But if we get here, if we get oil going lower again, then we expect to see US dollar CAD moving higher. So just to be aware of that correlation that's going on, and particularly be aware of the Euro CAD pair. That's a very interesting pair to be looking at. Yeah, so I hope that helps get us ready for the week ahead. So that is the main things coming up in the week ahead. What I would say is, it's a very, don't forget the intermarket correlations. Look off for that risk on, risk off trading. This could easily move on either US-China tensions with the, the closing of consulates in China and in the US. There's a tit for tat response between the two. Look out for that tension to rise. Look out for COVID-19 cases. If they keep rising across the world, that could easily turn the market risk off. And watch out for the political events happening in the US this week, and particularly the Federal Reserve interest rate meeting on Wednesday. So there's a lot of interesting factors, as well as the technological stocks. Facebook, Amazon, Apple, they've got their earnings release. So there's a lot of moving parts in the market this week. So be switched on and be very sure of any moves that you're taking. Don't forget, we do have another event on Wednesday. So Wednesday, I will be here again to help guide you guys through the market, and we'll be looking at an individual currency pair that I've identified as a dominant currency sentiment pair for the day, and we'll check back in on that euro pound potential swing outlook as well. So that's enough to keep us getting on with. If there's any questions, yeah, thanks. Just going to the questions now. Shua, how about US dollar, Swiss franc on daily time frame? Show strong support. Right, now this is interesting, and thank you for bringing this up. Recently, the US dollar Swiss franc pair has been stuck in a range. Okay, just when I say recently, since the financial crisis. Okay, so you got a financial crisis, you got this sort of range bound action between 0.9900, 9500, just sort of stuff. We now have the US dollar. Because the US dollar is weakening, okay, on the reflation trade out of the US is, coming into a reflationary mode. We also have COVID-19 cases. That's why we've seen the dollar index falling. So there's dollar weakness in this market. Now, here's the interesting thing, Shra. If we see a risk-off tone come into the market, then we should expect to see some more US dollar Swiss franc weakness. But as you say, we are in a very strong support level. You just look at this on the weekly chart and you can see that is very, very strong support. So at the very least, you expect profit takers at this level for sure. That is strong support. Now, fundamentally, the issue here, Shwa, is there's reasons for more US dollar weakness to carry on. Now, this is the thing to look for. If, for instance, we have a strong risk-off market and we start seeing US dollar strength come in on the risk-off tones, then we will potentially expect US dollar Swiss franc upside. And in that case, that support level could be very significant. So that's something to be looking out for. But I've been neutral on the dollar Swiss franc, the dollar Japanese yen for the last 2 months, 3 months really, because there's reasons for weakness and strength for both of them at the same time. But now we see the US dollar breaking away, focusing on that reflation trade, focusing on COVID-19 cases, and we're just seeing definite weakness in the US dollar. It's not moving like a risk currency as it has been. It is the ultimate safe haven, the US dollar, but it only comes into play as a risk currency when the market's really spooked. So now you can see volatility is a little bit lower. Just have a look here at the VIX. See the fear index. If you just take a look at this from a wider time frame, Shwa, look, you can see, look, volatility has gone right down compared to those elevated high levels. This is a good sign, Shwa. It's a very good sign. It's just showing that the market is feeling more relieved, less frightened, and as a result of that less fear, we are seeing the US dollar no longer acting as that really, big safe haven currency. Now, this is an interesting thing, Shwa, and this is an interesting thing about your question, Ghanemzi. How do you foresee US dollar weakness lasting for a very long time? Now, this is interesting. If we see say we see a good stimulus package that's passed on, then I would expect this US dollar weakness to carry on, because we're getting this divergence between Europe and the US. Europe falling COVID-19 cases, Europe large economic recovery fund, okay, that's positive for the euro. The US dollar has rising COVID-19 cases and still to decide on its stimulus measures. So that's why we're seeing these euro-US dollar upside. So if stimulus measures don't get agreed, expect more euro-US dollar upside and more US dollar weakness. So I do see a picture ahead for US dollar weakness. The only scenario I see US dollar strength coming in is a couple of ways. One, we might get some month-end flows, seeing some dollar strength, because might see some rebalancing towards month-end. Just looking at the month, it's a strong dollar selling month, okay? So we might well see some, month-end flows coming in there. Certainly one to watch, one to look out for. Also, we might see some dollar strength if we get something very bad happening in the market again, like a strong escalation of US-China trade tensions. If that escalates, get worse, then we might see the US dollar acting as a safe haven currency again, and then seeing the strength. Look, this is the strength we saw here in March, okay? When volatility was really high, let's just put the VIX on this. You can see here, look, when the volatility went up, the US dollar followed it higher, okay? And as the volatility goes down, the US dollar follows it down. So spike higher in the VIX, then expect spike higher in the US dollar. Nemzi, I hope some of those thoughts help you with that. If in doubt, and I have some doubt this week because I'm not 100% sure what the US dollar is going to do with the stimulus measures. So I want to wait and see. I'm not jumping into a trade. I'm expecting dollar weakness into Wednesday. And then I want to see what the Fed should say, and I want to keep my ears open for any news in the stimulus bill. So for the moment, this week, a more straightforward outlook for me is I'm liking that euro pound, just going on the crosses away from the US dollar for a moment until I understand that picture a little bit better. So I do favor euro pound upside, and also personally, I'm in favor of the gold and silver markets, although their dollar there is dollar influence there for sure. Just really keeping this open here. Okay, you can see a bit of a drop there in crude prices. Let's see if that's coming through into the dollar. See what's going on there. That looks like a headline, doesn't it? We'll get to that later. Okay, guys, thanks for your question, Shra and MZ. Don't forget, we're back here Wednesday at 12:30 GMT. Thank you very much, everybody, for attending, and I look forward to taking us through and running over some of these events on Wednesday as we get ready for the Federal Reserve meeting later. We'll go into that in a little bit more detail, and we'll also have a little bit more of a reflection on what we've been seeing in the markets up until then. So thank you very much and have a good afternoon. Thank you.